million during life. Here's your million. IRS says, oh, you gave them $1 million, 50% tax. That's $500,000. So one was a $100 million tax, one was a $500,000 tax because they're calculated differently. So that 50% tax for estate tax is really about a third tax for gift tax. And that's true at any rate. So right now it's a 35%, it's on sale if you want to die, estate tax rate. It's also a 35% gift tax rate, which really means it's about a 26% gift tax rate. And then if you have discounted assets, it's 15% discount rate, or gift tax rate. So I throw that out there as, it's not always better to eliminate the gift tax, but if the client doesn't want to pay gift tax, that's what all these are for, and most fall in that category. So that's the LPA lid. It's just one more thing to build, to have in our quiver. And like I said, you can just put it into the trust. And a lot of times you don't know what the trust is going to get. And maybe they're going to make an initial gift, but 10 years later or 5 years later say, we want to make another gift to the trust. So I would build into the trust a provision saying, the power of appointment is the portion of a gift in excess of the value stated by the donor. So, okay, you're telling me this is worth $1 million. We're writing that down. Let's sign this piece of paper confirming that. And here's the appraisal, perhaps. And if it turns out to be worth more, the trust says you'll have a power of appointment over that piece. In which case, by the way, let's say that actually occurs. They made the $1 million gift. IRS comes in, says it's worth $1.1 million. We've got a power of appointment over $100,000. If they don't do anything, when they die, that $100,000 is subject to estate tax, even if they have a surviving spouse, because it's still in that trust, and the power just lapsed. So what I would do is have them exercise in their will their power of appointment in favor of their spouse to get the marital deduction, at least defer the tax. So when I do the LPA lid, I also do a codicil of their will saying, by the way, if I have a power of appointment over this trust, I hereby exercise it in favor of my spouse or marital trust or what have you, if they want to defer that tax. So any questions on formulas and valuation formulas and LPA lids and laundry clauses? So I'm just hoping they don't overturn laundry, or maybe they won't even appeal it. So last, planning with disregarded entities. So what is a disregarded entity? It's an entity that is disregarded for income tax purposes. And there's a regulation, 301.7701, that says a business entity that's not a corporation, in absence of an election, is a disregarded entity separate from its owner if there's only one owner. So an LLC with one owner is a disregarded entity for income tax purposes. It's not treated as anything for income tax. A limited partnership actually could be a disregarded entity, even though, well, you're supposed to have two partners, right? There's actually a revenue ruling, 2004-77. So there's a limited partnership, and there was an LLC, that was the general partner. There's a corporation, that's the limited partner. But the LLC was owned by the corporation. So the LLC was a disregarded entity. So you disregard that. That means the corporation was the sole owner of the limited partnership. And so they said the whole thing is a disregarded entity. There's one owner of the LLC, and there's one owner of the partnership, and both of them are disregarded entities for income tax purposes. Doesn't mean they don't exist. They filed with the state. They're a valid LLC. They're a valid limited partnership, but they're disregarded entities for income taxes. So if it's disregarded, is it ignored for gift and estate tax purposes, in particular for valuation purposes? It would be nice to have it disregarded. We'll say why in a little bit for income tax purposes, but is it going to be disregarded for all tax purposes? If you look at 7701, it actually says it's disregarded as an entity separate from its owner, quote, for federal tax purposes. Sounds like, well, that would include federal gift and estate tax purposes. But the answer is no. And so I looked at this from two perspectives. First, there's logic. We know that doesn't usually apply in tax rules. But then we also have legal support. But both of them come out the same way. So first of all, the logic is the gift and estate tax test for value is what would a willing buyer pay? And what would a willing buyer pay for an asset that's a disregarded entity? They don't care that your asset is disregarded. I will pay what I'm willing to pay. And this is a limited partnership interest in a partnership your family controls, and it's wrapped up in this entity, and I'm not going to pay more just because you tell me while you own it it's a disregarded entity. So the willing buyer, willing seller test is going to say it's not disregarded for valuation purposes for gift and estate taxes. Disregarding an entity doesn't disregard the legal rights that are created by that entity. 2703 is for that purpose. It disregards certain provisions in partnership agreements. And by the way, if you could disregard it for all valuation purposes, then we could do a number on Code Section 2701. 2701 says if you want to form a partnership and have common and preferred, for example, or stock common and preferred, that you have to comply with 2701 and have all different bells and whistles in the preferred interest, or there's valuation issues. But if 2701 didn't apply because this partnership is a disregarded entity, then we can do common and preferred all day long and avoid it. But better yet, we've got legal support. So Revenue Ruling 2004-88 says, although the regulations in 7701 provided disregarded entities are disregarded for all federal tax purposes, these regulations do not alter state law. Well, that's good. Which determines his partner status as a general partner. So that was a good ruling. Then we had the Morawski case. That was a gift tax case, estate of Morawski. Mrs. Morawski owned an LLC. She was the sole owner, and she transferred LLC units to trust for her kids. And the tax court recognized they recognized that discounts applied. They could have said, you are the sole owner, it's a disregarded entity, and then you just gave pieces to your kids, but it was a disregarded entity, so we're going to treat it as if you just gave the underlying assets and not LLC units, but they did not. The issue in the case was valuation. Then we got what we were really hoping for was the Pierre case. Pierre came out in 2009, and there was a follow-up case. So they specifically ruled, they being the tax court, on whether a single member LLC is going to be disregarded for federal gift tax purposes. Just what I was waiting for. So Suzanne Pierre was the sole owner of an LLC. She transferred 100% of the LLC to trust for her sons. Part of it was a gift, part of it was a sale. By the way, she did the gift and sale on the same day. So each trust got 50%, part as a gift, part as a sale. What I also look at this case for is, if people have been concerned, if I'm going to do a sale to a grantor trust, can I make the gift on the same day? Do I need to make the gift a year before? Does it need to have this old and cold money? Well, in this case, it was not old and cold. The trusts were brand new. On the same day, they got 50% of the LLC, part as a gift, part as a sale. 10% of the value was a gift, 90% sale. It was not an issue in the case. Valuations were applied. The IRS argued that because the LLC was a disregarded entity, then she should be treated as having transferred the underlying assets and not the LLC units. And the court came to the rescue and said, state law determines the nature of property rights. Federal law determines the appropriate tax treatment. And the check-the-box regulations don't change this result. They do not apply to disregarded LLC to determine how a donor is taxed under the federal gift tax provisions. And to conclude that, the long-established gift tax valuation regime would be overturned, and it would be manifestly incompatible with the federal, state, and gift tax statutes as interpreted by the courts. So they're pretty much saying, as clearly as they could, that you don't disregard the entity. There's a state law partnership, there are real rights, there's limitations, and third parties would take that into account. And then finally, just to hammer it home, they said there was no state law legal interest or right in the LLC assets, and the federal law could not create a property right in those assets. All you got was LLC units. Then we had the Petter case, which you mentioned earlier, on the formula charitable formula. In this case, she also gave away, it was a single member LLC. She gave away LLC units to trusts and to charity. And the fact that the LLC was a disregarded entity was actually mentioned in a footnote. But that was that. It was a disregarded entity, period, best of luck. There was no discussion about it, and valuations were applied, or discounts were applied. So a disregarded entity is like a grantor trust in that you can have transactions with it. If a grantor trust, I transact with my grantor trust, there's no gift, there's no gain, there's no income tax consequences when I transact with my grantor trust. Same thing is true for a disregarded entity. So if there's an entity that I'm treated as the owner of it, when I buy or sell from my LLC or partnership that's disregarded, and by the way, I'm treated as the owner of it, then again, there's no gain. So how can we use this in estate planning? It's not a strategy as opposed to a way to increase flexibility. So number one, so let's say I set up an LLC, and I give away or sell part of it to a trust for my kids, a grantor trust. So let's look at the LLC. Who are the owners? Me, grantor trust as to me. I'm treated as owning the grantor trust assets and the grantor trust rules. So for income tax purposes, I'm the sole owner of this LLC. For property law purposes, I own half and they own half. But the LLC is disregarded for income tax purposes. So we don't need to file tax returns. We don't need to issue 1099s. It doesn't exist. In fact, if you look at forgetting the form name, but the SS4 to get a tax ID, the instructions say you can't get one for a disregarded entity. If you actually apply for one, just don't tell them it's a disregarded entity. They'll give you a number. But then they'll expect tax returns. This also means, so I have this trust. Here's me, my grantor trust, LLC. Here's the assets. I can buy assets from this LLC and not trigger gain. I can sell assets. I can lend. There's no income tax. There's no gain. So it's like being able to do it with a grantor trust. We know we can buy and sell with a grantor trust. But if the grantor trust owns an interest in a family limited partnership that's treated as a partnership, I can't just transact with that freely. There's gains as a result. It's me in a partnership. But if this partnership or LLC is a disregarded entity, I can transact. I can buy assets back from it, put the low basis stock back in my estate before I die. I can lend to it without income tax consequences. I can get valuation discounts because it's not disregarded. Valuation for gifts, valuation in my estate, depending on how we structured the partnership or LLC. It can be used to really enhance the wealth transfer. Let's take an example. I take my house, or let's take a commercial building. I put it into an LLC. There's lots of reasons to have a commercial building in an LLC aside from gifts and estate taxes. And what do? I give a third of the building to each trust for each of my kids. And we get a valuation, and we get a discount applied, because they each got a third of an LLC, non-controlling, non-readily marketable, took a discount on it. Building increases in value from $1 million to $5 million. I now want to buy this building back from them. Now, if it wasn't in an LLC, I'd have to go to each trust and say, I'll buy a third. And if I buy a third, I should be applying a valuation discount. Here's a third, but it's only a third. If I go to the one owner is this LLC. I'm going to buy 100% of the building from one owner. There's no valuation discount. So I gave it to them on a discounted basis, and now I'm buying it back on a non-discounted basis, and I'm not triggering gain in the process because I just bought it from a disregarded entity. So if you're picturing a chart, trust, LLC, building, I'm buying the building, disregarded entity, because these are all grantor trusts, no gain, and no discount when I buy it back. So these can be pretty helpful. We can also use these to minimize risk in a sale to a grantor trust. So sale to a grantor trust, we've got $1 million trust. We sell $9 million of assets to the trust for a note. That trust is highly leveraged. So it's got $10 million of assets, $1 million of equity. If it goes down 10%, we've wiped the equity out. Obviously, we hope it comes back. But there's assets at risk. And maybe this isn't a $1 million trust. Maybe this is a $10 million trust. They may use their gift exemptions. And now we want to lend $9 million of assets to this trust. Well, we're putting $10 million at risk. So what you could do, the trust could take, it's got $10 million of assets. It can drop $1 million down to a LLC that it forms and owns. So it's got $9 million of assets here, $1 million down in this LLC. Now I sell my assets, I sell my $9 million asset to the LLC for a note. The LLC has $1 million of assets. That's its equity. Don't break through the LLC, limited liability. If that sale turns out to be unsuccessful, the asset declined in value, the LLC runs out of money, but the $9 million is still intact up here in the trust. And we do the same thing all the time when we form entities. If the trust wanted to start a company, doesn't want to put all of its money at risk, says, well, we need $1 million of seed money for this company. Let's drop $1 million into a corporate form or a partnership or LLC. When that company goes bust, we didn't jeopardize all the other trust assets. That company went bust. We lost our investment. Same thing here. We want to invest. Let's have the LLC drop some of its assets down, enough to provide equity, but why put all the assets of the trust at risk? And being a disregarded entity, grantor trust, single member, disregarded entity, we can sell assets to the trust, we can take back a note, there's no interest income, there's no gain in the process. Now, if you really want to amplify wealth transfer, so let's say we've got $1 million trust, and the client's got $100 million of assets. Well, we can do a $9 million sale, and that's great. We can do a $90 million GRAT with everything else, but maybe that's not practical because of the nature of the asset and the cash flow or all the other risks with a GRAT and issues. So we're stuck with this $10 million transfer, and we've got 90 sitting over here that we can't play with. So what if we use a disregarded entity to amplify that? So we've got our $1 million trust, and actually let's start with a what did I have in my trust here? So we want to do a we've got a trust with $5 million of assets. So the trust drops $1 million down to an LLC that's wholly owned by the trust. That, or I'm sorry, here's my example. We've got a trust with $5 million. We sell assets to that trust for a note. We leverage that up as much as we can. One of those assets happens to be an LLC. So the trust now has its original gift, and it bought this LLC, and this LLC has $30 million of assets in it, and it bought a piece of the LLC. So let's say it bought a third of the LLC. So this LLC is owned partly by the trust, normal gift and sale. There's a note owed by the trust. I own part of the LLC, so does the trust, and there's 30 in this LLC. Let's say I own 2/3, they own 1/3. This LLC has $30 million of unencumbered assets. I also have this closely held business over here. I sell stock in my closely held business to the LLC for a note. The LLC has $30 million of unencumbered assets. I can do a really, really large sale if I'm doing 10% equity. Sell the whole thing if I wanted to. So we have the equity of the trust here leveraged, and then the trust happens to own this company. And it's no different than if it bought Acme stock from our client, and the Acme company then turns around and buys something on a leverage basis from our client as well. But here it happens to be a disregarded entity. So normal gift and sale of a disregarded entity, then client sells another asset to that disregarded entity. Now, I think for appearances, shouldn't be some kind of asset. Wait a minute. It would be better if it's two different partnerships or the closely held stock versus securities. Really amplify the leverage by doing this. You have your 1 that turns into 10, and then we've got this LLC down here that's got free assets. If we were to sell $30 million of assets to this LLC with $30 million, it's 50% equity, which is better than we've got in the trust. So it's one more way to amplify. The only way to use these disregarded entities. Like I said, the main purpose is the flexibility of being able to buy and sell and lend to them. Because the big issue with these grantor trusts and these sales is the debt to equity issue. Is 10% enough? You would think after 20, 30 years of doing sales of grantor trusts, we would have some kind of answer in some form. But there is no 10% rule anywhere. And if you look at these cases we've been talking about, the Pierre case and the Petter case, both of those actually had 10% equity and 90% sale. But there was no blessing or saying it was right or wrong, one way or the other. So we just don't know. And the risk with this equity issue is if you sell assets to a trust for a note, and the IRS says that wasn't a note, we think because of the terms, because of thin capitalization or whatever other terms, that's not really a note, that's a transfer with the retained interest. Well, if it's a transfer with the retained interest, it doesn't qualify under 2702, it's a gift of the whole thing. And by the way, because you retain that interest, it's also in your estate if the note's still outstanding. So if they recharacterize it as transfer of assets with a retained interest as opposed to a note, it's a very bad result. Like I said, fortunately, and somewhat surprisingly, we haven't had any guidance on this issue, but people seem to stick to this 10% equity, and it seems to be working based on the cases we've had lately. The issue with that double strategy, sale to the trust, do second sale to the lower level LLC, Is there step transaction risk? Possibly. I guess if you step everything together and say, step transaction says we're going to disregard the intervening steps and look at the end result. Well, what's the end result? We got assets up here with a note. We have assets down here with a note. The end result is the end result. I don't see an issue, but I still think it's better. Don't do them on the same day. Spread them out. Do the initial gift and sale. Let that cook before you do the second transaction to really leverage it up. But we do have cases saying transactions in close proximity don't seem to really be a problem. In the Pierre case, and as I noted, that one, the gifts and sales were made exactly the same time. In the Holman and Gross cases, that was formation of a partnership and then gifts, and they were made 7 days after the partnership was formed. So it doesn't seem they're looking that closely. And actually, even the Linton case, that was the 2 Cuperts with the discounts. That transaction was all the same day, so separated into 2 pieces and then immediately gave it to the Cuperts. One last point on disregarded entities. So S corporations ordinarily cannot be owned by partnerships or LLCs, but they can be owned by a disregarded entity because the entity is disregarded. It's not treated as being owned by an LLC or a partnership. But the minute the grantor dies, it will not be a disregarded entity unless there's only one owner still. So if a trust is the only owner of that LLC, then you're fine. But if there's 2 owners, it'll be a partnership, and you'll have a problem. So on its face, it's at the outset it's okay, but not if the grantor passes away. So just one more thing to have in the quiver, and so like I said, it's not a strategy, but it's something to think about. Whenever I set up family limited partnerships or LLCs, I look for, well, one, I like to use grantor trusts anyway because it's a free wealth transfer. Grantor paying the tax every year. If you're willing to give away $5 million, then hopefully, got the fly bugging me. You're hopefully, there's more behind that, and you can also pay the taxes, and that's a freebie every year. Take it or leave it. Well, you have to take it. No gift tax returns, no valuations, and they should be doing that. So if there are grantor trusts involved, if we can make the partnership owned only by the grantor and the grantor trust for the kids, it's a disregarded entity, it really increases our flexibility. I have one client right now. We've had these long-standing LLCs. We've done all sorts of transactions, transfers. One of the main assets it has is Berkshire Hathaway stock. Only he was able to buy it at $100 a share way back when. Obviously, a little bit of luck. He claims it was knowledge. There's no one. You don't turn $100 into $130,000 a share with anything but luck. But he is now buying back that stock from these LLCs, which are owned by grantor trusts for his kids, so that if he passes away, we get a basis step up from $100 to $130 or whatever Berkshire is trading at these days, which will more than cover our bill. So it just created that flexibility, because if it was not a disregarded entity, he couldn't buy it back from the partnership without triggering the gain. So all for flexibility. And so any questions on this last section? So there's a quiz they're going to be passing out. It's going to start with RPM trusts, followed by LPA lids and decreasing grats. Yes. So the question is, does the disregarded entity work with the beneficiary defective trust? And make sure we're all on the same page. So that would be a trust I create for one of my kids, and it's treated under 678 as a grantor trust as to my child. We won't go into the details of how you might do that. But so the answer should be yes. So it's a grantor trust to the beneficiary, and that grantor trust owns 100% of this LLC. Now, if I own the LLC and my kid's grantor trust does, then that's not. That's 2 different parties.
But if the kid is just doing all the planning.
Right. Exactly. Any other questions? Well, thanks very much for having me here. A real honor.